cap rates can be misleading. I was in New York City about a month ago visiting with investors, and I had, a happy hour with a bunch of my investors and had some dinners and met up with some friends. One of the things I did is I met up with an investor, and he owns a hedge fund, so he's financially savvy. He owns the hedge fund, so he's 80 people he has on his team or at his company hired, and he told me about a group he invests with in Manhattan, New York City. They buy at a two cap. And at first he said, Joe, man, I was so sticker shock. I was thinking, how are you all buying these at two caps, but then generating healthy returns? And he said, so at first I was like, no way, no, thank you. But then I looked at it and I saw the healthy returns. I was like, okay, how are they doing this exactly? And in their case, they focus on rent stabilized. Yes, rent stabilized. Rent is that the right term for New York? I can't remember. Rent. You know, Theo, where you can't raise the rent.
Oh, no, I know what you're talking about.
Yeah, it's on the tip of my tongue, and shame on me. I lived in New York City for 10 years, and I'm forgetting the term right now. Basically, you can't raise the rent, or you can raise it incrementally. I think it might be called rent stabilized. I can't remember. Anyway, they focus on those apartment buildings, and the reason why they focus on those, because it seems counterintuitive. You need to add value, but why focus on apartment building where you rent to the market level? And the reason why they do that is they said there tends to be some shenanigans going on at those apartment buildings where the person who has the rent stabilized, pretty sure that's what
it's rent control.
Rent control. Thank you. I appreciate the Google search. A rent controlled apartment building or apartment, some cases, they will transfer that to someone else so that the apartment still stays in their name under the original person, but in reality, it's that original person no longer living there. So they have some sort of process. I think they do some electronic key card or something like that. I didn't really ask too many specifics about how they do the value add. The point is that they buy these two cap properties, and they have a unique method. And my investor said they have 3 ways to add value. The other 2 are pretty much what we do. You renovate, increase the rent if it's non-rent controlled. But basically, they're increasing value through methods of a business model, and they have the team to execute the business plan. And they're buying at 2 caps, but then the cash flow is very healthy. And I didn't ask him what the type of returns I should have, but I didn't. But he was happy with it. And, again, he owns a hedge fund, so I figure they're going to be pretty good returns. That's a 2 cap property. And if we were just to look at the cap rate, then that's not the most relevant thing. When we do look at cap rates, I believe the relevant things to look at is, 1, what's the market at? So you want to make sure you're buying competitively, and ideally you're buying better than what the market is, but at least competitively. But really the money's made in these large apartment buildings with the business plan and the execution of the business plan. I believe with cap rates, you also want to conservatively project that the economy will be worse when you sell. Therefore, the cap rate on your exit should be projected to be higher, and that should be factored into your project returns. You shouldn't project that the cap rate will be the same, or definitely not lower when you sell. If it is, then bravo, you've just nailed your investment plan. Because you projected it to be worse, which is higher when you sell, but in reality it's the same or lower. So great, you did a great job, and you made a lot of money for your investors, and you did too.